Welcome to our deep dive on turning an $80,000 cash pile from a source of anxiety into a disciplined plan. Today, we will move step by step, beginning with a quick win to stop the financial bleeding, then building a foundation, maximizing tax advantages, and finally deploying a proven market entry strategy. By the end, you will have an actionable framework you can implement right away. Here is the agenda for our video. First, we will identify why inaction is costly. Next, we will move through step 1 by moving cash into a high-yield savings account. Then, we will secure the foundation by paying off high-interest debt and building an emergency fund. After that, we will maximize tax-advantaged accounts. Finally, we will look at a practical dollar-cost averaging plan, show sample allocations and timelines, and highlight common pitfalls. To conclude, we will test your knowledge with a couple of quick quizzes. Before we begin, please note that this content is for educational purposes only and does not constitute financial advice. Consequently, you should consult a qualified financial professional who can consider your unique goals, risk tolerance, tax status, and timelines before making any decisions. Now let us address the cost of analysis paralysis. When large sums sit in cash for extended periods, inflation quietly erodes purchasing power. Therefore, doing nothing is effectively a decision to fall behind. However, there is a simple first move that reduces risk and buys you time to finalize the rest of your plan. Step 1 is to stop the bleeding immediately. Move the entire surplus into a high-yield savings account the same day you decide to act. This simple action secures a competitive interest rate, preserves liquidity, and reduces decision stress. Meanwhile, your money starts earning something rather than sitting idle. This holding tank approach creates breathing room while you plan the rest of your deployment. This flowchart shows the entire decision path. First, idle cash moves to the high-yield savings account to earn interest. Next, we check whether the foundation is in place. If it is not, we prioritize paying high-interest debt and building a 6-month emergency fund. If it is ready, we proceed to maximize tax-advantaged accounts. Then, we deploy dollar-cost averaging into a diversified, low-cost index fund, such as a Total Market ETF. Finally, we automate contributions and review quarterly to stay on track. Now let us secure the foundation. First, eliminate high-interest debt such as credit card balances and personal loans, because their rates usually exceed expected investment returns. Second, calculate 6 months of essential living expenses and set this as your emergency fund target. Third, keep this emergency fund in your high-yield savings account to maintain immediate liquidity. Only after both the debt and emergency fund criteria are satisfied should you proceed to investing. Next, we maximize tax advantages. Begin by funding your available IRA, whether traditional or Roth, according to eligibility and tax considerations. Additionally, ensure that you are capturing your employer's 401k match, because that is effectively a guaranteed return. For children's education, a 529 plan offers tax-advantaged growth and flexible qualified distributions. Throughout, prioritize low fees and broad diversification to improve long-term outcomes. This table summarizes the recommended priority order. First, park funds in a high-yield savings account immediately. Second, pay off high-interest debt before investing, because eliminating expensive interest is often a superior risk-free return. Third, build a 6-month emergency fund to maintain resilience and liquidity. Fourth, maximize contributions to tax-advantaged accounts to improve after-tax returns. Fifth, deploy dollar-cost averaging into a diversified index fund using 12 monthly tranches. Here we compare lump sum investing and dollar-cost averaging. Lump sum involves investing all at once and historically can yield higher returns when markets trend upward. However, it carries greater emotional and timing risk. Dollar-cost averaging spreads purchases over time, which reduces timing risk and is often easier to stick with behaviorally. Although it may underperform a rising market, DCA helps many investors stay invested, which is frequently the more important success factor. For step 4, we recommend a 12-month dollar-cost averaging schedule. Split the remaining investable capital into 12 equal parts and automate monthly purchases into a low-cost total market ETF. Then, review your plan quarterly rather than reacting to daily news. This provides structure, reduces stress, and helps you continue learning while the portfolio grows. This pie chart offers an example allocation of $80,000. First, the emergency fund takes a substantial portion to establish resilience. Next, retirement accounts and 529 contributions are funded to capture tax advantages. Finally, the remainder is committed to the dollar-cost averaging plan over the coming year. Your exact numbers will vary, but the order of operations remains the same. This sequence diagram shows interactions among the investor, the high-yield savings bank, the employer plan, and the brokerage. Initially, the investor opens a high-yield savings account and transfers the surplus, after which interest accrues monthly. Next, the investor verifies enrollment in the employer plan to capture the match and funds IRAs as eligible. Then, the investor instructs the brokerage to automate the monthly dollar-cost averaging into a total market ETF. Finally, the investor conducts a quarterly review and rebalances as needed. Here is a concise checklist. First, transfer the full surplus to a high-yield savings account. Next, pay off high-interest debt and build 6 months of expenses in the same account. Then, maximize eligible IRAs and capture any employer 401k match. After that, set up 12 monthly automated purchases into a total market ETF. Finally, schedule quarterly reviews and define simple rebalance rules as guardrails. Keep fees low, automate contributions, and avoid market timing. Quiz time. What is the first move you should make with a $75,000 to $85,000 surplus to end analysis paralysis? Option A. Start picking individual stocks immediately. Option B. Move the entire surplus into a high-yield savings account. Option C. Wait for a market dip before investing. Option D. Put half in crypto and half in cash. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to move the entire surplus into a high-yield savings account. This earns interest, preserves liquidity, and breaks the cycle of indecision, allowing you to plan calmly without losing ground. Second quiz question. How large should your emergency fund be before you proceed to aggressive investing? Option A, 1 month of expenses. Option B, 3 months of expenses, of to half. Option C, 6 months of expenses. Option D, 12 months of expenses, always. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 months of expenses. This level typically balances resilience against emergencies with the opportunity cost of holding too much cash. Let us recap the key takeaways. First, inaction is the riskiest choice because inflation erodes idle cash. Second, move your surplus to a high-yield savings account to earn interest while planning. Third, secure the foundation by eliminating high-interest debt and building a 6-month emergency fund. Fourth, maximize tax-advantaged accounts, including IRAs, employer matches, and 529 plans. Fifth, deploy a 12-month dollar-cost averaging plan into low-cost, diversified index funds. Finally, automate contributions, review quarterly, and avoid market timing. To summarize, move your surplus into a high-yield savings account today. Next, confirm the foundation by paying high-interest debt and securing a 6-month emergency fund. Afterward, maximize tax-advantaged accounts. Then, automate a 12-month dollar-cost averaging plan into a total market ETF. Finally, review quarterly and stay the course. If you follow this sequence, you will transform indecision into disciplined execution. Thanks for watching. If this video helped you, please like it, share it with a friend who needs a plan, and subscribe for more practical guides. In the comments, share how you would allocate your next $80,000 and what step you are taking today to defeat analysis paralysis.